What's up, YouTube family? It is the beginning of November of 2023, and let's talk about the economic news of the moment. What's going on in the economy, and what does that mean for you? First of all, the US economy grew at a 4.9% pace last quarter. That's the fastest rate of growth since 2021. Consumer spending also jumped at a 4% rate. Why is that? Well, the economy's main growth engine is personal spending, and people are feeling pretty flush with cash. People who are homeowners are sitting on a lot of equity right now because home housing prices have gone up over the last few years. So people who are existing homeowners have seen a huge rise in their equity, in their net worth. Meanwhile, due to inflation, there's a thing called the wage price spiral, where when prices get higher, a lot of people get higher wages, and it actually contributes to inflation. So it's a bad thing for the overall economy, but for a given individual, it gives them more disposable income. So there is a bit of a momentum in consumption that's happening right now, but there are a lot of economists who believe that it is not sustainable. And people expect that in the fourth quarter of 2023, they're going to see some of this decline, especially as personal savings wane and as student loan repayments resume. Personal savings, as you recall, hit a record high during the pandemic. And so as people work through those savings, there are economists who are predicting that the rate of consumer spending will probably shrink. Now, on the topic of student loans, the student loan pause has ended, but there is a big cluster F in the world of student loan payments. More than 830,000 people missed their first student loan payment because, not by any fault of their own, but because a particular servicer called the Missouri Higher Education Loan Authority failed to send timely statements to 2.5 million borrowers. So that's the biggest error, but there are a lot of servicers who are just making loads of errors. There's one servicer who accidentally told some borrowers that they owed more than $10,000 a month, and actually it told a few borrowers that they owe more than $100,000 a month because they accidentally set the repayment terms to 1 to 2 months rather than 120 to 240 months. Oops. Nobody wants to get a bill like that in the mail. So the end of the student loan repayment pause and the resumption of student loan repayments has a lot of just bureaucratic and administrative tangles with it. And borrowers are complaining about incredibly long wait times. It's really hard to contact somebody. So if this is you, if you are a student loan borrower, bear in mind that any headaches that you're facing, any errors with your bill, check your bill very closely, make sure there are no errors. If you do catch them and you need to contact your servicer, contact them during off-peak hours. So for example, if your servicer takes phone calls starting at 7 a.m., call them at 7 a.m., right? Call them during an off-peak hour because the phone lines get jammed very quickly. The labor market has been really robust. We talked about the GDP being high, to consumer spending high. Labor market is very, very strong. The joblessness rate, the unemployment rate, is 3.8%. It's held steady at 3.8% for the third consecutive month. That is historically rock bottom low. Now, what's strange about this is that worker expectation of joblessness is actually quite high. According to Glassdoor.com, discussion about layoffs in online forums is at its highest point since July of 2020. So there's a disconnect between the data and sentiment, right? In terms of the data, we're seeing record low unemployment, 3.8% holding steady for many months. But in terms of sentiment, people are worried that they might get laid off. And a large part of that is due to the fact that there are some very high profile layoffs that we're seeing in the headlines. For example, Schwab is laying off between 5 to 6% of its workforce, which is 2,000 employees. We've also seen big layoffs in the tech sector. Google, Twitter, of course, huge layoffs across a lot of very high profile major companies. And so a lot of people are worried about layoffs, despite the fact that the US continues to add new jobs in aggregate. It added 180,000 jobs in the month of October. And so what this means is statistics don't matter to the individual. Like, it doesn't matter to the average person if the US is adding more jobs, is adding hundreds of thousands of more jobs. That may not matter to you if you're worried about your particular industry or your particular sector. But it's an interesting thing to note, that there's this disconnect between economic data and sentiment. Inflation jumped to 4.2%. It is the highest since May. That is not good. But the good news is the Federal Reserve, just met. They concluded meeting on November 1st, and they decided to hold interest rates steady. Meanwhile, over in Europe, the European Central Bank also decided to pause any interest rate hikes. So both in the US and in Europe, rates are holding steady. They are neither increasing nor decreasing. Now, here in the US, the Federal Reserve is going to meet one more time this year. They are meeting on December 13. Are they going to raise rates or not? That is literally the billion-dollar question. What we know is that the Fed has chosen to hold rates steady for 2 consecutive meetings now. They met in September, held it steady then, met at the end of October, early November, concluding on November 1st. They held it steady then. And so they have now held rates steady for 2 consecutive meetings. Does this mean the end of rate hikes? Maybe, maybe not. We don't know. What we do know is that inflation is currently at 4.2%, and the Fed's target rate is half of that. The Fed's target rate is 2%. In the world of housing, there was a huge court verdict that could completely upend housing and real estate as we know it. There was a landmark court ruling in which a group of sellers decided to sue the National Association of Realtors as well as a handful of major brokerages. And they won, and their settlement is $1.8 billion, billion with a B. So these sellers, who are all based in the state of Missouri, they alleged in their lawsuit that the National Association of Realtors conspired to act in an anti-competitive way by virtue of the very structure of the business. So basically, here's how it works. When you go to sell a home, there is a listing agent who represents the seller, and that listing agent lists the property. And then there's also a buyer's agent who represents the buyer. Now, the seller of the property pays for both agents. The seller of the property pays both for the listing agent and for the buyer's agent. So the seller of the property pays about 6%, typically split, in the state of Georgia at least, it's split 2.8% for one agent and 3.2% for the other agent. So the seller is paying 6%, taking that 6% haircut, which means for every $500,000 worth of home, the seller is paying $30,000, right? That's a big, big, big haircut off of what the seller is collecting. And so this group of sellers said, wait a minute, why are we doing this? Why do we have to pay for the buyer's agent? And now the history of this goes back 100 years when the multiple listing service, also known as the MLS, was created. The MLS is the platform through which buyer's agents and listing agents find one another. And the rule is, if agents use the MLS, then the listing agent has to pay a commission to the buyer's agent. And so it's kind of set into practice this precedent, this tradition, that the agent representing the seller, known as the listing agent, always pays a portion of that commission to the agent representing the buyer. And meanwhile, the person who's buying a home doesn't actually have to pay their agent out of pocket, right? So these sellers got together and said, look, this is ridiculous. For every $500,000 worth of home, we are spending $30,000. That is a lot of money. We shouldn't have to take this 6% haircut. And the jury agreed, and the jury awarded a $1.8 billion verdict against the National Association of Realtors and against several major real estate brokerage firms. Now, the National Association of Realtors says that they are going to appeal, so this is going to wind its way through the court system. But depending on what happens in future court cases, depending on how that appeal goes, there is at least a possibility that the entire business model of how homes are bought and sold might very fundamentally change. So that's something particularly for anybody who is a homeowner, for anybody who's interested in one day selling their home and doesn't want to pay a 6% commission. This is something to keep a very, very close eye on, because it may be that that 6% haircut that you thought that you might have to pay, that might get substantially reduced, which would result in a savings of tens of thousands of dollars. So keep watching that. Finally, last piece of news, it's about credit cards. There's a proposed piece of legislation. It's called the Credit Card Competition Act. Proposes capping the fee that merchants have to pay credit card companies if, every time somebody swipes, every time someone uses a Visa or a MasterCard, the merchant has to pay the credit card company a fee, right? And if you're Target or you're Walmart, that you can handle it. But if you are a small business owner, if you own a little corner shop, that fee is pretty substantial. And so the Credit Card Competition Act is supposed to be good for small business owners and is supposed to increase competition among credit card issuers, right? That's what the advocates for it say. However, people who are opposed to it will argue that if this passes, it is likely going to eliminate credit card rewards. Almost everyone on both sides actually agrees that if this passes, it will likely eliminate airline rewards, cashback, hotel points, all of the rewards associated with credit cards. Airline, co-branded cards, airline cards, and hotel cards are likely going to be the worst hit. Also, in terms of the reduction in fees, small local credit unions are actually likely to be hit the hardest. So credit unions are opposed to this bill because they are very much reliant on those fees. We're talking very, small local community banks and credit unions. So it's a very, very controversial bill. I am actually, as soon as I'm done recording this, I'm about to go hop a flight to a conference for credit card media where I am going to attend a debate between a leading advocates both for and against the Credit Card Competition Act. So stay tuned, hit subscribe for a future YouTube video where I'm going to go into a lot more depth about the nuances of the Credit Card Competition Act and what it might mean for you as a credit card user and potentially as somebody who enjoys the rewards that come from your credit card, who enjoys the cashback or the airline miles. So stay tuned for that. All right, that is a synopsis of where we are in the economy right now. Thank you so much for tuning in. I did a much longer podcast episode about all of this, audio-only podcast episode about all of this. You can find it on Spotify, on Pandora, on Apple Podcasts, on any major audio podcast player. So thank you so much for tuning in. Thank you for watching. My name is Paula Pant. I'm the host of the Afford Anything podcast and the creator of this YouTube channel. Make sure you're subscribed. Give us a like. Leave a comment. Let us know what you think about any of the things that we talked about in this video. Thank you so much for being part of this community. I'll catch you in the next video.